Hello, everyone. Welcome to this talk on distributed power and off-grid solutions in the Middle East and Africa. So we're in a small little room today, but I think that if we look at the way trends are emerging in the Middle East, Africa, but also globally in the next few years, we can probably expect that we'll be in a much, much larger room, I think, because the trend is towards greater decentralization of the generation of electricity. And I think it's fair to say also that there's a huge trend these days towards PV. And so what we're looking at today is the deployment of off-grid and distributed power in the Middle East and also in Africa with a focus on PV. I've got two guests today. First is John Frenkel, just at the end. He's the managing director of Centennial Generating Company. And that's a company that focuses on off-grid, but also grid-tied solar PV solutions with storage, primarily in Rwanda, but also looking at other markets in Africa. And then to his side on the right, I have Jeremy Crane, who's the CEO of Yellow Door Energy, which is a distributed generation solar company which currently focuses primarily on Dubai and its Shams Dubai net metering initiative that some of you may be familiar with, but also Jordan and its own net metering initiative, wheeling initiative. So two really good panelists today to give us a bit of an insight into what they're doing, the opportunities they see, the challenges that they face in the Middle East, the Gulf, as well as the Levant, which obviously have different sites of features, and then after also in sub-Saharan Africa, a focus on Rwanda, which it's fair to say is emerging as a very hot market for solar power, renewable energy, and distributed generation in Africa. I'll let them obviously expand a little bit more on what they're doing and some of their latest achievements. But before that, I'll talk a little bit more about some of the recent trends in the market in distributed power. I think the huge trigger for a lot of these trends has been just the huge decrease in the price of PV over the last few years. So I think it's fair to say that over the last 5 years or so, there's been a decrease of about 60% in the price of a solar PV facility. And so that has obviously completely changed the grid parity dynamics in many markets. And so when you look at places like Jordan, when you look at places like Rwanda, developers like these can offer savings to commercial, industrial, but also residential off-takers that go into the 10, 20, 30, sometimes even 40% discounts of what the utility may be able to offer, or indeed may not even be able to offer because they may not be a grid at all. So, as I said before, given this business case, we're seeing this emerging trend now towards greater decentralization of the generation of power, which is leading to bigger or better, more developed or new regulatory frameworks and incentive systems in order to permit greater deployment of such market. And so we're seeing at a different level the trend of decentralization emerge. And I guess there are sort of three that I would have identified. The first one is the utility scale ground-mounted solar PV facilities, so the types of facilities that you'll have that would be captive to a mine, for example, and we're seeing a lot of that in Africa. We're seeing that also in places like Jordan. Then there's the smaller scale rooftop facilities, whether they're commercial and industrial off-takers or residential, so sort of start building on the experience in places like Germany, for example. And then the third strata is the pay-as-you-go, sort of smaller scale facilities that we're seeing emerge now, primarily in Africa. And I think just mainly in the past few months, towards the end of last year, we've seen a huge ramping up of all these trends, huge activity in the DG space, whether it's in the form of new tenders in places like Jordan and in Dubai, with very large distributed generation projects being tendered by the likes of Orange or Lafarge or DP World, and other, of course, directly negotiated deals that you may never even hear about. And then after the trend that we sort of see on the sort of pay-as-you-go type business model in the last few months, some very high-profile investors backing some startups that are selling solar panels to off-grid customers in Africa, India, but also East Asia. For example, there's Generation Investment Management, a London-based fund started by David Blood and also the former US Vice President, Al Gore, that led an investment round where Virgin's Richard Branson also participated and Steve Case, the founder of AOL, also participated for an investment round of $19 million in a startup from Kenya called M-Copper. And this rapidly growing startup created by one of the founders of a mobile payment system in Kenya called M-Pesa is knowing an extremely successful period at the moment. And it's basically using this mobile payment system as a backbone for its business to provide a pay-as-you-go financing solution for its distributed generation or pay-as-you-go solar PV system provision business. A Bloomberg report said that the average of grid that an off-grid Kenyan spends on energy is $272. 164 of that $272 goes to kerosene, 36 goes to charging cell phones, and 72 goes to batteries. And Copper says that its customers, if they switch to solar, they could actually save around $750 over a period of 4 years. So in countries like these where many people are below the $2 poverty line, that's obviously a huge game changer. And that's obviously focusing right now on the residential, but the type of savings that can be offered to industrial and commercial producers obviously creates a very compelling business case. There's also another company called Off Grid Electric, which just a couple of days ago here at the WFES won the Sheikh Zayed Future Energy Prize. It recently raised $45 million in debt financing for the deployment of its distributed generation business and facilities. And it also benefited from an equity raise of $25 million, which was led by DBL Partners, which also invested in the likes of Tesla and Solar City. So when you have these kind of investments being made by this profile of investors in what some would call frontier markets, it gives you a bit of a sense of what's happening and the things to come. And so it really is a huge and exciting opportunity. And so I'm really delighted to be here today and to have these two great panelists who can tell us a little about their experiences, the challenges that they see, the opportunities that they see, and their commentary on some of these trends as well. So without further ado, I'll pass it on, and in the meantime, I'll ask Jeremy to just tell us a little bit about himself and what he's doing here with his business.
All right, thanks, Mark. Great introduction for our very exciting segment of the market. And I think the one thing that I'd add to that is we're having a discussion over lunch just now about the percentage of the solar market that is distributed versus, let's say, conventional or utility scale. And the two statistics I heard were that in Germany, 70% of the solar generation is distributed. In the US, 50% is distributed. So while right now, as you said, this might be a fringe sort of presentation or discussion, it's certainly going to grow. We know that in this region, grid constraints are a major barrier to growth. In the Middle East, not maybe even more so in Africa, but we see a huge opportunity for the distributed energy to be rolled out to help people service their growing needs for power, where 5 years ago, the thought would have been conventional power, extending lines. What we are targeted on at Yellow Door is providing people a lower cost alternative to central generation. And in Jordan, where prices of power are as much as $30 a kilowatt hour, there's a lot of opportunity for that. I can see some of our friends from Jordan here in the audience who could attest to that. In Dubai, it's a little bit of a different market. It's a little bit more competitive in the energy space. It isn't everything else, but we still see potentials to offer customers here a discount. So we're structuring our company, Yellow Door, as a utility, a service provider, somebody who's going to be offering a customer an easy, long-term stable source of power that gives them some pricing advantage versus the grid and versus their neighbors. That, in a nutshell, is what we do.
Great, thanks very much. Brilliant little intro. John, pass it on to you. Tell us what you're doing in Rwanda. Tell us what your company's about, and also your recent achievement.
Oh, thank you. So basically, Centennial Generating Company is focused in East Africa. And in the region, Sub-Saharan Africa, there's a lot of focus on solar for large-scale projects, which are, of course, built in rural areas and then shipped to city centers. And then there's a lot of focus on solar for rural areas for the solar is very small. The size for the solar panels is not too much larger than this water bottle, and it's being sold to villages. And both of those are very important. However, in a region where half the population by the end of 2030 is going to be in city centers, what we're focused on is commercial industrial customers in those cities or in regions that are nearby cities. So that C&I space focused on businesses, I think, is very important. Because where we're focused, the cost of power is very high. We're talking 23, 24, 25 cents per kilowatt hour. And also, it's not too stable. So what we offer solutions is really a turnkey solution where we finance the system, we install it, we own it on their premises, we also operate and maintain it, and then we sell them the power that our systems produce. At the same time, we also offer some battery storage, not 24 hours, but even at 2 hours, we're able to really change their operations. Because at least in Kigali, where we're focused and nearby, about 85% of power shortages last for less than 2 hours.
Okay, I've got 2 points. The first one is you need to tell us about your achievement because you dodged that question. So if you could just tell us what that project was and what was recently achieved, then I'll just come back to the storage thing because that's interesting.
Yeah, so I started the company after actually working as a project finance attorney for a number of years and had the opportunity to work with Mark at Chadbourne. And then really started going to Kigali in October 2014. And we spent 2015 really listening to customers to make sure that we were offering a product that they really wanted. I didn't want to just come to market and say here. And so through that experience, we were able to start to talk to customers. We're very conservative about marketing because we really want to show performance. So we don't just want to tell people that we're hoping to bring something. The Genocide Memorial, which is the top tourist site in the country, is our first customer, and we just broke ground there on Monday. So we're very excited about that. We have a number of other customers that will quickly be coming as well. But yeah, so we're very excited to have that milestone.
That's great, congratulations. So coming back to the storage dimension then, that's not necessarily something that, all off-grid DG solar developers are offering yet, and it's obviously really interesting given the 2-hour dynamic that you were talking about. So you're saying most of your PV installations that you install are actually grid-tied, but your battery solution combined with the solar PV facility is actually not only to just store for the sake of storing, but also because the grid is so unreliable, or at least there are periods of unreliability that last generally no more than 2 hours, you're able to bridge that, to provide that buffer so that the solar PV kicks in, whether it's night or day, with that storage,
right,
in order to bridge that instability of the grid.
Right, and it's very important for different customers, including just on last Friday, I was talking to a fitness center, and they have treadmills. And when the power shuts off, people go flying because it stops, and it takes 15, 30 seconds for the generator, if they have one, to kick on. So we'll keep that person running on that treadmill safe, and really for all the different customers that we're working with. For instance, at a factory, they make nails, and just for fun, I kept one of the nails, and it's in my bag behind me here. But again, the power goes off, and even if the generator is going to kick in, it takes a while for that machine to ramp back up. So by having batteries, it's a seamless transition from the solar or the utility mains to transition to the batteries. And then when we know that the battery is starting to run down, then we can start the generators there. So we can really make sure that they're always on, and that's huge for customers.
Yeah. And Jeremy, so you focus obviously mainly on Dubai and Jordan, but you mentioned also about the tariff in Jordan, how high it is, the one that the government offers, which is obviously driven by the fact that Jordan has very little hydrocarbons, and so the business case in Jordan is so huge. Where are you having the most success? Are you finding, is it with commercial and industrial, and is it mainly with international businesses or local businesses? What are the types of customers that you're targeting mainly, and what types of installations? Is it sometimes ground-mounted DG or sometimes rooftop? What's your sweet spot, basically?
Yeah, well, so every market's different. Every market has its own regulations and dynamics. But speaking specifically about Jordan, there's different tariffs for each industry segment. So obviously, we target the segments that pay the most. These are telcos, hospitality, hospitals, schools. These are the segments that are paying, all of them over $20 cents, and some of them over 30. So that's an easy way to break it down. Industry in Jordan actually is quite inexpensive. They pay around 10 cents, dollar cents a kilowatt. So there's a big gap there with one segment essentially subsidizing the other. Where we're finding success in that segment is first and foremost with people who have roof space. They've got a roof, you can put solar on it, it's simple, it's a no-brainer. You're gonna go ahead and do it as quickly as possible. Now, the question is, do you look for a company like Yellow Door that pays for everything, hires the contractor, manages, and gives you a long-term performance guarantee that you're going to be getting power from your system, or do you go and finance it yourself and build it yourself? Well, what we've seen in market after market, year after year, is that as the market is nascent and beginning, people don't trust solar. They're going to go for a solar lease or a PPA, the sort of thing that we would provide. Once a market becomes more mature, there's more of a bifurcation of the people who are very focused on their businesses. Maybe they're making, maybe they have a shopping mall, maybe they have a hospital, and they want to save money as quickly as possible. They want to limit their capex, and they don't want the hassle of power generation. Again, Yellow Door fills that space. The other segment is people who are perhaps long-term investors or intrigued about solar themselves, and they're going to go ahead and build a plant themselves. They're going to hire a construction company. And so we see that difference in Jordan. So that's a second segmentation. So where we're at now, that Jordan's a couple years old, is finding those people that or is working with those people that are not interested in funding, putting out CapEx, but are interested in immediate savings and low hassle, long-term stable systems.
Yeah, okay, interesting, thanks. So if I understand correctly, both of you, your commercial models are predicated on you pay what you consume, what you're getting in terms of electricity. So contrary to some of the sort of larger scale IPPs that are project financed with an SPV acting as the borrower, getting debt financing from a set of lenders, where there may be an energy charge variant and there may also be a capacity charge, a fixed cost. Here we're talking just about variable charges. So in other words, no capacity charge and you're just paying for the electricity you consume. But John, if you don't mind expanding a bit, and I can keep coming to you for the storage element, because obviously it's so different, something that you're offering, but how do you structure the sort of the offering of the battery? Is it also a variable charge, the capacity charge? How is that structured, and how do you meld those two things together?
So what we do is we bifurcate the PPA. So we have a variable charge for the solar, and then a capacity charge to help for the batteries, and if we also include a genset that too. We make it clear that we don't take on fuel risk. We might help to negotiate fuel prices for our customer, because that really plays into our focus on being a hassle-free solution for our customers. So essentially it means that we have variable solar and a capacity charge for batteries and maybe gensets.
Okay, interesting. And Jeremy, so we talked in the past a few times about the extent to which on these distributed solar projects we can raise debt. And I know that as people start to look, more and more seriously to these opportunities, and they start looking to the growing opportunities and all these different offtake agreements that they'll have with commercial, industrial, or maybe they'll break their business up into the different segments, and then after have all those receivables go into one holding company, and people then start thinking bigger and bigger about how they finance all this, but also how they optimize their financing costs. And what we've seen in sophisticated markets like the US, for example, is holdco type financing where a developer may front the financing of these projects on balance sheet to start off with, but then after enter into so-called back-levered debt finance transactions where cheaper debt financing is brought down the line, and so some of the equity can then be released and brought back to the investors. I know that you initially said when sort of all these trends were emerging in the Middle East that you were very skeptical about the extent to which or how early we could bring lenders on these transactions. Now, with the benefit of these couple of years' experience on the ground here in Dubai, has your view evolved a little bit, and at what stage do you think we can start bringing in lenders?
That's a good question. Let me first start by just clarifying. I know I'm sitting between two project finance specialists here, so I just want to maybe break down my views a little bit on where I see debt fitting into our model, and then let me explain how that's evolving. Because yes, in the US we are seeing structures, yield codes and other types of things that are developing where a developer builds up maybe 10, 20, 30 megawatts of distributed generation. Perhaps you could call it securitizing, perhaps you could call it something else, rolling it into a yielding structure of some sort. We've also seen some of those failing over the last year. There's been some pretty high profile cases of that sort of spin out of operating assets facing some challenges with valuations, with defaults, with problems. So that's not the model that we're focused on. Our model is to, like a large corporation, like a utility, to bring in corporate level debt to optimize our capital structure. So yes, we want to obviously get the most for our equity, highest yields possible for our investments. But we don't want to over-lever to the point where we are at risk of default in the event of one problem or another problem. So that's our fundamental philosophy. And I've talked to people here in Dubai, and I've talked to people in Jordan that are heavy believers that they can bring in debt on small projects. I have yet to see a commercial bank that doesn't have access to some sort of a special credit facility offering non-recourse project finance type of debt to distributed generation in this region. I just don't think the banks are there, and I don't think they're going to get there for a couple of years. Could be proven wrong. We do have an interesting phenomenon in Jordan, as many can attest to. We have certain funds that have been put together specifically for the commercial banks to tap into and provide loans. But those loans are being done on a collateralized basis, which are irrespective to the fact that it's funding solar. Because solar is involved, people can access lower costs of debt, but it requires you to have the balance sheet or the asset portfolio outside of solar in order to access those funds.
Just bouncing on one point you made, you said because it's solar they can access a lower cost of debt. Why is that?
Thank you. So these funds have been put forward to incentivize businesses to move into solar, A, to reduce the burden on them for the high cost of power, and B, to reduce the burden on the government who's losing money on generating power.
Okay, interesting. What about you, John? Your experience in Rwanda and wider Africa, have you reached a stage yet where you're starting to look at potential debt financing solutions? Have you talked with DFIs, the likes of the African Development Bank or the World Bank or otherwise, to see whether they may, be supportive of the type of initiatives that you're doing?
Yeah, well, the support's there. The question comes to the check that they would have to write. I mean, when you're looking at $10 million or more, then you can interest a Hermes or an OPIC. But sort of given that we're talking about a small project at, at a small tourist site, and we're just starting to aggregate projects into larger project financeable portfolios, we're not quite there yet. When we are there, it would be interesting to work with DFIs, whether it's for the first round or for a scenario where it's they come in for existing a portfolio that has already been financed, and then we could roll that into a portfolio that's larger from there. But what we really try to do to prepare ourselves for that is standardize across our projects. So that means that our agreements are pretty standardized, and also something else that we've incorporated to mitigate the credit risk is we're working with a financing party, and they basically backstop the payments on most of our projects. So that standardizes
Well, that's really interesting, because that's not something that we've seen typically in the Middle East, or at least not yet. Right. So just for the benefit of those in the audience, so what we're talking about here is, in order to mitigate the payment risk of the off-taker, there are some multilaterals in Africa that are prepared to offer some sort of solution to backstop such off-takers. Jeremy, how, as I said, we don't or haven't yet seen those types of solutions in the Middle East. How are you seeking to mitigate payment risk of your off-takers? What sort of options or alternatives are you providing for in your off-take agreements? And I guess what kind of market reactions as well are you having in terms of the proposed solutions that you're giving?
Well, first I'll say that I have been told that there are some sort of credit enhancement facilities for customers in Jordan. So I haven't directly experienced it, but we're told they're out there. Generally speaking, our view is that the cost of those doesn't go far enough to provide the benefit that we couldn't self-insure, so to speak. So what we do is we have a very rigorous customer acquisition process, where post signing a deal, we do a credit analysis on each customer. We have a team that's structured to do that, a credit committee that approves each investment, and that's an important part of our business and our a value proposition to our investors, and ultimately I think what will in the long run mitigate our exposure to default. Now, as far as security with customers are concerned, there's a whole range depending on the region you're in and the laws that are allotted to you. But the standard things you could do are get post-dated checks for payments. You could take a deposit. You could take, in Jordan they call it a cambiala, sort of like a check or a guarantee. We could get a parent company guarantee. We could get an owner's personal guarantee. But those are the options that are sort of out there to the market. And I think you have to make a decision on a case-by-case basis. How strong is your counterparty? Are they going to be around for 10, 15, 20 years? And then gauge your requirements accordingly. I think in Dubai, everyone knows that most factories don't have 20 years of operating history today. So projecting that out is challenging, and it's one of the biggest issues that the Dubai industry faces for sure.
Okay, and then moving away a little bit then, and in about 5 minutes or so, I'm going to pass to the floor to ask a few questions as well. But one of the things that interests me as a project finance lawyer, because this is the type of thing that we do day in, day out, is how you structure your commercial arrangement, so the contract. We know that in certain markets, for example, the national utility sometimes has the monopoly on the purchase of power. Those are long-held monopolies which are, in fact, intended to prohibit the type of decentralized power which is the subject of it today. But we see that evolving now in places like Dubai, for example. I mentioned just at the beginning when I started talking about the introduction of this new net metering program, which effectively permits now private investors to develop PV projects and to sell power to entities other than the local utility. And so it's opened up, albeit for a very narrow little portion of the market, only PV, but a separate regulatory system for PV, for distributed PV in Dubai. And so we've had to think about our clients a lot about how you structure the offtake, because for a while we couldn't structure it as a PPA. And so we had to think, okay, well, what kind of alternative can work from our purposes from a business case, but still be within the law in Dubai? And the same applies to Jordan, where we're having similar questions. We've seen PPAs. We've also structured our offtake agreements as leasing agreements, and sometimes had debates about whether the lease agreement is a finance or a capital lease or an operating lease, and to what extent it would be deemed to be on the balance sheet or not. That issue, by the way, we understand is no longer an issue, because the IFRS no longer makes a distinction between finance leases and operating leases, and so any lease that you structure is going to be deemed on balance sheet. That's changed only very recently, which is relevant for distributed generation development companies. So I mentioned PPA, lease, but also the third one that's sometimes employed in another market, which is the model of the energy saving company, or the ESCO model, which sometimes gets around the prohibitions on providing power, because they're effectively you're a provider of energy efficiency or energy saving companies. And so sometimes we manage in certain markets to get where we need to be in terms of the business model, but shifting a little bit contractually. So I'll ask each of you. Jeremy, as you said earlier, I completely appreciate it depends on the markets you're in, but tell us a little about, perhaps, if you can, about the way you structure your contracts, your offtake agreements in Dubai and in Jordan. Then I'll pass it on to you, John.
Sure. Well, thanks to the support of Chadbourne, we've spent a lot of time and I think have a very strong model to go to our customers with. In both Jordan and Dubai, there are, as Mark alluded to, restrictions on selling power. You're not allowed to, without a generator license, sell power, and generator licenses aren't something that you can walk into a supermarket and buy, at least from what I know. So we lease equipment to our customers on a long-term basis. Mark's completely right. There is no distinction between operating and financing leases today. So the leases do show up as an obligation on our customers' balance sheets. We require them, perhaps it's a 15-year lease, we require them to provide us with payments over those 15 years, and a default under that would be a default on the contract and be subject to certain events. So it's a fairly simple structure. We lease the equipment. We have a projected value that the customers have to pay for every month. If the system performs higher, i.e. generates more kilowatt hours, or performs lower kilowatt hours, those payments are adjusted accordingly. And then we provide a backstop, a guarantee that it won't go below a certain percentage of the expected generation. Customers are contracting us because they want savings, so we need to provide that sort of a guarantee.
Before we move on to John, just one question on the last point you made, which is just a very sort of beginner's question, I guess, but it's worth asking. Why do you need a performance guarantee if you've only got an energy charge and basically you're incentivized to produce, because if you don't produce, you're not getting paid? Do customers not buy that?
We've had a lot of discussions about that with different customers, and the reality is the customer says, I've only got one roof, and I want to use that to save money. If I can save 40% by putting solar on that rooftop, you better be generating from that rooftop. And so, yes, we do have to put our money where our mouth is and provide a guarantee that our system will perform at a specific level. And if it doesn't, we have to compensate them for their lack of savings.
Okay, interesting. John?
Yeah, the system we have is not too different. We sign a PPA 15 to 20 years. At the end of the PPA term, at first we were thinking that maybe we would have some sort of extension, but we just hand the asset at year 20. And we really do that as a carrot. We want the customer to feel obligated to make their payments on time, and if they do so, then at the end of the term they can have it. To answer your question about the minimum output, that was something that we felt the interests were aligned, because we're not making revenue unless our systems are operating well. However, similar issues, customers feel that if it's not solar PV on the rooftop, maybe it's satellites or some other way to generate revenue. And also they want to make sure that even though we have the right intentions now, we'll maintain that. And so if we don't operate a certain minimum, then we'll, then there will be all sorts of damages and stuff like that. But we call it a PPA, but essentially it becomes a lease for the capacity charge. And that's paid down over a 4 to 5 year term, depending on who the customer is. And then at that point, they own that asset, the capacity system, as we call it, whether that's the battery and or the genset.
Okay, great. Well, I could ask many, many other questions, but I'm going to give a little bit of a chance to the audience. We've got about 10, 15 minutes now. So if anyone has any questions, please fire away. Great, we have one question in front.
There.
Since you brought your team here and started things, would have been maybe, thank you. Kate Baxter from Green Hedge. We do solar storage and other integrated energy solutions. I just mentioned, you sound like you're from another place, North America. Mm-hmm. What have been some of the greatest struggles for your company for both of your companies, as you have come to these different areas and done business? Is your team mainly from the area? How do you integrate your business in this area?
Sure. I think that there's a perception problem for Westerners coming to, I'm focused in East Africa, so I'll talk about that. They've heard it all before. A lot of Westerners come and make a lot of promises. So when I come in and I say it's hassle-free for you, you pay no money up front, you get the solar, you get savings, you can have more stable power, they think it's great. But I've been very conservative in, of course, marketing until we have proof of concept and we're out there, as I'm very upfront about, but also just we only get paid if there's performance. And the customers like that because, again, they've been promised many things from many Westerners. And so we really want to make sure that we're able to back that up.
So I'm Canadian. I'm Dubai-based now. I've been here for, in the region since 2011. And I think I've lived around the world, and every time you go to a new country, you have to adapt. You have to change. You have to learn the business practices. And I think the best way that a foreigner coming into a new place can do that is by working with local partners and a local team. In our business, in Yellow Door, we have a mixture. We have people who have multiple passports. We have people we have a few Canadians. We have some Europeans, but we have concentrated on bringing in the experts that are needed to execute on the projects, as well as the, I'd say, more regional people who understand the market, understand the sales process. And I think a business that's going to be successful requires the merging of both, requires the merging of international experts, if they don't exist locally, and the local know-how. So that's what's driving us forward.
Great. Any other questions? Okay, well, in that case, that gives me an opportunity to ask another very dry legal question. One of the things that we've seen in some of our negotiations with off-takers, and I'm talking about private off-takers in the DG space, is the risk allocation under these off-take agreements. And for example, one that comes up often is change in law risk. There's obviously a certain amount of authorizations and permits that you need to develop your project. You're banking on those authorizations being in place, and sometimes procuring those authorizations is often the responsibility of your off-taker. So you don't have control on that, but you're banking on it, and indeed your lenders may be banking on it down the line. It's staying in place. But the off-taker may say to you, hey, hang on a second, I'm not a government entity. This is not in my control. So this change in law risk that you're trying to offload to me shouldn't be with me. At the very least, it should be between us. It should be shared. It should be a force majeure event rather than an off-taker risk event. Do you often see that pushback? Where do you tend to land? And I guess one further point is we often separate between general change in law risk, where, for example, you lose your permit to generate and you're completely prevented from carrying out your obligations under the agreement. That would be the first general change in law risk. And the second one would be a change in law which materially adversely affects your economics. Sometimes in some markets we see some off-takers accepting that second type of change in law, sometimes perhaps subject to a deductible, where they'll say, okay, well, if there's a change in law and your project economics are materially adversely affected, below a certain threshold, you, developer, take the hit, but above a certain threshold, I agree that I'll take the rest of the hit. And sometimes that's where developers land, because someone has to take some share of the risk, or there needs to be some element of risk sharing. What's your experience in respect of this particular little feature?
I'll let Jeremy start. He's probably more experience in that regard so far.
All right. Well, so I've done a lot of project finance, quite a bit with Mark in the past, and change in law when you're dealing with governments is simple. A government utility has control or is directly affected by the law, can directly influence it, so it's clear. When you're dealing with commercial entities, most of the time, they don't have any impact or any influence, on the law, and so they are very shy to take on obligations. But at the end of the day, you got to keep it simple. If you try and break it down into too many buckets and try to predefine too much, you're just going to scare your customers away. So we try to keep it pretty straightforward. Essentially, in all of our scenarios, the development risk, be it permits, be it offtake contracts with the utility, we take on that risk, and it's pretty easy to do that because that's risk that we can pretty much eliminate before we go into construction. Before we've spent any significant money, we can eliminate most of our permitting and utility risk. Post-construction, one of the things that we hear about in the region here, of course, is taxes. What happens if suddenly someone slaps a 10% tax on us and we're not even making 10% on our money? Well, that could be disastrous. So we do require that that there is a commercial correction to keep us whole in the event of that sort of a change, and generally speaking, we find customers are comfortable with that. If you're selling somebody Coca-Cola and 1 year it's $1 a bottle and the next year it's $1.10, they understand it's going to go up. We're signing a long-term contract that has limited or at least contracted escalation that doesn't account for increased operating costs due to government changes. So normally a customer will be pretty comfortable taking on those long-term risks in order to make it an equitable playing field for everyone.
Okay, and John, actually, I've decided I'm going to ask you a slightly different question, just thinking about the tariff structures. Sometimes we see, the traditional sort of large-scale IPP model where you have a fixed tariff per kilowatt hour. Mm-hmm. But what you also see on distributed generation, because there is this element of what you, the private sector, can save for these private entities, where you have a pricing model which is effectively saying, okay, well, your rate will be the utilities rate minus X percent. What kind of tariff structures are you thinking about? Are you offering alternatives, or where do you find you're getting the most traction with your potential customers?
Yeah, it's a good question, and it's something that we've really debated a lot, because a side of you wants to just float it and just guarantee, say, 15% savings to the customer. But then the side of you that has to talk to investors decides that doesn't really work. So what we do is we right now are looking at where's generation in the areas where we're operating. And in our country, being in Kigali, throughout the entire country, there's 126 megawatts for 12 million people. And even if they get up to the 500 plus megawatts that they expect over the next 5 years, still it's just not going to be even close to what they need. They talk about shipping power in from Ethiopia or Kenya, but then I haven't really seen the transmission lines built yet, or even talk about it. And there's talk about it, but you haven't seen real tangible things happening. So on September 1st, the power price just went up by 35% to 182 francs per kilowatt hour, which translates to about 24.5 cents. Historically, power prices change every 3 years or so. So anyways, what we do is we have a fixed price for 7 years, and our customers are pretty comfortable with that because most people agree that prices will be pretty stable, very high where they are right now for at least the next 3, 4, 5, 6 years.
Okay, and I've got a question that just came in from someone from the audience here on the iPad, and we're all very modern here. What is the size, the typical size of PV power plants that you typically have for these off-grid projects? What's the sort of bracket that you would say typically in Africa?
For Centennial, I mean, we're looking at anything from 20 megawatts, sorry, from in terms of kW, maybe 15 kW, scaling up to, we're currently working with a factory that'll be about a 400 kW project. We can do larger. Going smaller below 15 kW doesn't become that interesting. It's only interesting because you can actually fly the equipment from Germany instead of ship it, so it's a lot faster.
And you, Jeremy?
We have defined our market as 100 kilowatts to 10 megawatts. Long term, I expect our average project size to be about 1 megawatt.
And because John, also something else that we didn't sort of address yet, but we've obviously got utility scale, rooftop, but you also offer a slightly different solution, which is this container-based solution.
For some customers, we can. There's actually a company that we're working with where in Kigali right now, there's a lot of government building, meaning your house you're building today might be a road in 3 weeks. So we really need to make sure we can modify the PPA pretty quickly, or the project. In the PPA, we have a modification clause for this and similar reasons. And then for one of our customers, we are building a solar system on top of a container, and then it has some batteries and all of the equipment inside. So.
Okay, great. Any more questions? Great. Could someone bring a mic?
Thank you. Tess Sunderland from Greenhedge as well. I'm curious to understand in your two respective markets and the market segments where you operate, what would you say is a typical customer conversion timeline? So if you want to give me your average timeline between first conversation with a customer to a signed contract.
I would say 6 months for us.
Yeah, our average was blown out of the water this week. One customer started in September 2014, and we're just building that now. And another, we signed the PPA right there on the second conversation. I met him 2 days earlier. So it really depends on who the customer is and what their needs are.
I was actually speaking with one of our clients at the moment in Dubai that's developing a leasing model for its distributed generation projects, and apparently a senior executive in one of their potential customers was so desperate in signing the lease to have some sort of understanding with the developer that they made him come into the office and made him sign a one-page document to actually make him sign something to calm him down a little bit because he was so desperate to get into an arrangement. Anyway, do we have any more questions? Because we're running out of time. Great, one last one and then we're off.
Thank you. Ghislaine Steensma with Advision. I just have in the two markets that you have, what is the typical distribution between distributed and off-grid type of plants that you construct?
What we're doing is very early, particularly in urban areas, and that can probably be said for most of the region. So the distribution would really be mostly on off-grid in rural areas. I'm sorry, the distribution was the wrong word because that confuses the two that you asked me about, but the large percentage is off-grid in rural areas.
In our markets, there's a very high grid penetration, so I expect we'll be doing exclusively on-grid for the near future with perhaps a few exceptions.
Great. Well, thank you very much, John and Jeremy. It was great. Cheers.